what happens is you're digging for this one idea you have, and then on the side, you see something glimmering and you're like, wait a second. And that's the big idea. And so you can't find that unless you dig, and you can't dig unless you have time.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. Our guest is Eric Balchunas. Eric is the senior ETF analyst for Bloomberg. He is the host of the Trillions podcast. He is the host of the ETF IQ show on Bloomberg TV, which I love and we're going to hear more about. He is the author of the Institutional ETF Toolbox. So Eric is everywhere covering ETFs. He's Eric Balchunas on Twitter and the most prolific analyst covering ETFs. But ETFs are interesting because ETFs are two things. It's a fascinating industry and an industry that has exploded in growth, and there's all sorts of interesting stories and angles there. But ETFs are also global macro. It's sectors and countries and asset classes, what's moving by flows, what's moving by performance. So it's really a fascinating area to cover. Eric is also a good friend. So Eric, thank you for joining the podcast.
Thank you for having me. And I agree with you. I always tell people ETFs are so fun to cover because one day you're in China, the next day you're in like healthcare. And so you kind of have to be a mile deep and a mile wide, or at least try. And so you're at once a specialist and a generalist, and you get to follow the news around. I mean, even the recent story with GameStop, there's an ETF angle, and I enjoy that because I get bored pretty easily.
I agree with you. I think you do have to be a mile deep and a mile wide, and I think you do that quite well. And there's a saying that you had a few years ago that I loved. You said that the ETF industry is the Silicon Valley of finance. And at the time, ETFs were, really just hitting their critical mass. They were just hitting their tipping point. And there were all sorts of innovators and startups and interesting things happening in the industry. I think that's still the case, but way, way less so. And the industry has changed so drastically over the last several years. You've been covering it for, how long have you been covering it?
Since 2000 and I want to say about 6. So I guess that's about 15 years. I remember GLD had just come out when I started covering it. So I think it was 2004. So right around there, 15 years-ish.
So that, and that's a while. So, and, I should add on that you're still a young guy. So you must have started that job as a teenager. But the point is that, ETFs being the ETFs being the Silicon Valley of finance, do you think that's still the case? And tell us what the industry was like back when you started back in before the global financial crisis, and what it's like now and how it's changed over the years.
Well, back then it was kind of similar. I was just looking at the new launches by year, and 2007 was one of the biggest years of new launches. I think it held the record for about 6 or 7 years after that. I think 2018 or something might have broken that record, but there was a lot of weird stuff launching in 2007. I mean, that's when you had this is back, you had health shares. So you had like the dermatology ETF. There were definitely some things that got way ahead of where the market was. But I also remember adding tickers like where it was a whole new category. I don't know, like the first high yield fund or that's a general one, but like maybe DXJ that had, currency hedging. A lot of the things were still, there was a lot of white spaces, I guess, at the time. And now there's a lot less white space for sure. And so it's become harder to innovate. And so what happens is you get people competing on fees much more and trying some really crazy stuff. I still stand by the Silicon Valley argument in that if you are looking to try something out, see how it works, the thing is all the money's going to ETFs. So you kind of have to go there. So it draws in people for that reason. And it's kind of mostly a meritocracy. And so it's kind of like, I don't know, like a big app store. Which apps sell, which don't. And obviously that's kind of up to the public for the most part. Although more and more to your point, we're seeing people plan distribution ahead of time. We call it BYOA, where they plan out at least, maybe a 30 million, 100 million in assets. That way they're not sitting there in 3 million.
BYOA stands for?
Bring your own assets, which is a phrase that I just randomly tweeted out one day because people always say something like, oh, so-and-so's late to the ETF party. Like when Transamerica comes in, it's like, 2015, it's like, or a big asset manager like that. People will say, oh, well, they finally came to the ETF party. And I was like, well, the party's still going on, but it's like a BYOA party now. I mean, you can't. The organic stuff is pretty much going to Vanguard and BlackRock. There's not much left over, and so I think there was this, I don't know, sobering up of, hey, I can't just put this ticker on an exchange and everybody's going to love me and buy my stuff. It's way harder than that. That's why, I frequently call it the Terrordome. It's very, very difficult to gain organic assets.
So let's talk about the Terrordome, right? The Terrordome refers to the fee war and how brutal it is, right? And I know I've been on that side of it, and you're trying to charge a fee that, it costs something to run these funds. And when you're at the scale of a Vanguard or BlackRock, you can charge just a few basis points and it'll pay for the fund, for the management of the fund. But you have to be at scale in order to compete in that way. It's really, really brutal. And you see flows move based on the tiniest change in fees to the downside. Of course, it's a one-way wrench. It only goes down. Tell us a little bit about that. Tell us about what the Terrordome is and how it's impacted the industry.
Yeah, I mean, on the one hand, we have this phrase, we say it, lower it and they will come, which is like, and it's like fee of dreams. And we actually made a funny movie poster parody. And instead of the Chicago White Sox coming out, it was like all the big advisory firms. It's like lower it and they will come. And it's true. They are very price sensitive, and people don't talk about the demand side enough, but obviously this is driven by advisors who have gone to the fee-based model. They have seen a lot of the SPIVA reports, which is active versus passive. They are now getting paid not by the fund company giving them a commission, but by as a percentage of the client assets. So they have a lot of motivation and incentive to go for the cheapest products and to do products that won't really give them any problems with the client. So you get a lot of flows going to cheap beta. And that's really driving it. Was if you charted the assets into ETFs, they would correlate to two things: the rise of the internet and the rise of the fee-based advisor model. Those two things correlate very well with ETFs and I think Vanguard in general. Vanguard really took off when those two things took off too. And so I think that's driving it. And that's why it's just very difficult. And then it gets even tougher because if you come in cheap and you're not like a real big company, you might even starve there too. We've seen some companies try to go with like really cheap funds, but people also sort of trust the brand name of BlackRock, State Street, Vanguard. And so that's why there's, we kind of look at the flows into dirt cheap and shiny objects. And the dirt cheap's going to get about 70% of the flows. So everyone else is fighting over the 30%. And what tends to work there is stuff that's very different, whether it's Cathie Wood and ARK, a theme ETF. You could even have package trades like a DXJ or the new ones that the buffer products. Those what I call like prepackaged trades that you have to go out and do on your own. So you got to get very creative over there, do something very different. The middle of the road is where it's just no love. And that's going to be stuff that's maybe 40, 50% different than the market and charging like 50 basis points. And that's how portfolios, I think, are emerging. A lot of people's portfolios, if you talk to them, are like maybe 80% real cheap beta. And then they experiment and go a little crazy with the other 20%, which arguably might be a behavioral tactic, because if you can have fun with that, it might keep you from touching the 80%. So that barbelling seems to be a reflection of how portfolios are developing, and it shows up in the flows.
So 20% or so, give or take, to the shiny object stuff, and that would be your thematics, your wild swings, your fun stuff, like you said. And I think that's a big part of it, fun, right? I think a lot of us as product developers, and I came up in the industry as a product developers, we take ourselves very, very seriously. Investing is serious business to be done by very serious people. And now you look, right, and you have these Redditors and different people, YOLO options, and it teaches us a lesson. Don't take yourself so seriously, right? People want to have fun. You're right. For the vast majority of their portfolio, they might just be in very sober, cheap, safe index funds, but they do want to get a little wild with the fun stuff. What are some fun ETFs that you could think of that had a little bit of success in recent years?
I mean, the one that came out that everybody was like just crapped on, and I kind of get it, is the work from home ETF. I mean, talk about exploiting a trend immediately. Like it's got 144 million and it charges 45 bips. That's a hit product. I mean, that's gonna hang around for a while. Like if you issue that, you're fine. I mean, that's not a flop.
The work from home ETF. What is it? It's just like Zoom and DoorDash.
Yeah, let me look at the holdings here. I have, forgive me here, some of these Plantronics, 8x8, NetApp, FireEye. I mean, to its credit, it looks like it does go after that trend in a more pure way. On the flip side, one that came out that really, I don't know, was a little odd to me was the BioThreat ETF. This one also came out with the news of COVID. And you think, oh, what am I going to get, like vaccine makers? But this one has like a portfolio that's very beta-ish. You've got Netflix. I'm not sure how that's maybe because if there's a bio warfare going on, we're going to watch a lot of Netflix. I guess there's a case there. Walmart, Home Depot. I guess it's illogical.
I mean, that's a work from home ETF. It sounds like.
Yeah, there's some definite overlap there. Now, on the flip side, one came out called Germ, which to me is called I love the ticker on this one. And this is the ETFMG Treatments, Testing, and Advancements ETF. I mean, it has 60 million, but it charges 68 bips, so that's profitable. And this one is going to go hardcore into some small biotech firms like Moderna that are making the vaccines. And so you're going to have, this would be, again, I think part of the shiny object. It's built for max pop potential. It's probably giving you stocks that aren't hugely overlap with your beta. And that's ultimately, I think, what Cathie Wood figured out as well. She only has 1% overlap with the S&P, and she's very different. And so a lot of these theme ETFs are starting to come out, and they're very different. My colleague, Athanasios, who I call Tom Seraphagus, he has a chart that shows the average number of holdings of new launches, and it's definitely coming down. More of these products are built for pop potential because that's their only choice. If they don't want to go dirt cheap and charge 4 basis points or something ridiculous, they kind of have to just be built for a moment in the sun. And what's interesting in this year, we have products that are built for the moment in the sun, but then they close too early. Like the short squeeze ETF would be having a kick-ass year. That index, the ETF didn't follow this index, but an index of the most shorted stocks is up something like 300% since March. But the ETF closed 18 months ago. It just couldn't hang on. And so part of this is just being patient and waiting for your moment to arrive. Jets is a good example. So I know the theme ETFs, I'm with you. If you approach this as a serious Vanguardian investor, it all seems pretty silly and just chasing after the wind. But people like it, and we have to cover it, and we try to find out what works, what doesn't. And if you are interested in themes, we try to tell you, okay, how much does this ETF actually capture that theme? What's the capture score? Just so you know that you're not buying something that just holds the same stocks you already own. So we're just trying to help people. We don't judge anybody. You want to have fun and go crazy with the themes, fine. You want to buy VIX and deal with the rolling, we're just going to try to point out some of the things that are beneath the surface that give you good consumer information. But certainly there's a taste for fun stuff, as you say.
Yeah, and I think that's the right approach. I mean, nobody needs another scold to tell them what they can or can't invest in. And I think on the product side and the issuer side, the smartest people in our industry are sitting there tinkering over multi-factor models, over what the best value model is to capture. And sometimes you just have to say that people also want to have a cocktail party fund, right, that they could talk about. People want to have, hey, I have conviction. I think, video games are hot. I'm going to buy a video game ETF. I mean, there's a place for that. And I don't think we should, be too snobby about investing to not enjoy that and to not, recognize that there's a legitimate place for that. But that's where we are now in the industry. Talking about the shiny object thing, everything's going into cheap beta except for the small sliver of, shiny objects, so mostly thematic funds. But that's where we are today. Let's talk about where the ETF industry was, and where the ETF industry primarily made its hay is in the active versus passive debate. Right? ETFs representing passive and mutual funds representing active. And I know there are passive mutual funds and active ETFs now and all sorts of overlap in between. But back in the day, that was pretty much the line in the sand. Would you say today that the war is over? And what are flows telling you, are non-transparent ETFs the bridge here? What are you seeing in the active versus passive debate?
Well, I think definitely, I think passive has won that argument for the most part. We just went through a year where the Qs took in a lot of money. Is that passive? No, probably, right? If anything, that might be innovation beta. It's basically all these visionary founders who like to list on the NASDAQ. That's all that is. But I guess it is passive. It's rules-based. Then you've got something like the S&P, which showed us that it's clearly active. I mean, they have a human committee. We don't even know who these people are. They sound like, they meet in some dark back room of a restaurant to decide who goes in and out. We actually had David Blitzer, who used to run the committee on our podcast. We had a good time with him. But clearly, all these rules are put in by human beings. And so nothing's really passive. I think the closest thing to passive is VTI or the total market. And that was the biggest inflow getter last year. So there's definitely a taste for people. And I kind of like that. If you have, as Dan Egan said, I thought should be the advertisement for VTI. It's FOMO proof. There's nothing that thing doesn't hold. So whatever is happening, you own it. So it's owned Tesla for 10 years. And so I think what we are going to see is a slight shift from the S&P to the total market. I think people because if there's a small cap, like the size factor grows or the value factor grows, or small value, which is the size and the value factor together. Remember, that factor dominated the 2000s. It made large caps, it totally crushed large caps. If you own the total market, you kind of don't have to worry about that. And I think we're going to see some refugees from these other indexes settle in with the total market. So I think VTI has the best shot to be the biggest ETF or knockoff SPY. And on the active side, we call it the fall and rise of active. We think that the idea of running a 65 to 90 basis point active mutual fund where you're close to the index, that's probably going to go extinct. At least the flow showed this. What is forming, though, is themes. So this would be, we call it, kind of new active themes, which are rules-based themes. ESG is a form of active. All this is just organizing stocks in different orders. And smart beta. Smart beta had the lowest take of that slice of the pie last year. So what happens is smart beta dominated that sort of new active. People who want to do different than the index, but we're looking for something cheaper and rules-based and in the ETF tax-efficient structure. Smart beta was perfect. It was like active, but in a much better delivery mechanism. Well, now themes and ESG are now competing over that. And you got Cathie Wood, which is what we call like the shiny object, or Babe Ruth active, which is really swinging for the fences. So yeah, there's a lot more competition, and there's an appetite for it. People are buying it. The $120 billion went into that area last year. The one, again, active non-transparent to me, you would think is a bridge, but we think organically that's probably going to be a tough sled. I think they're going to have to bring their own assets over because, as I said, if you look a lot like the index, if you look enough like the index, but you're charging active fees, no one buys that. DFA did something kind of smart. They are, pretty close to the index. They own some of the stocks. They did what GSLC did, which is the Goldman active beta, which is they're trying to tell you we can try to outperform, but we're only going to take little bets. But guess what? We're only going to charge you like index level fees. Advisors can get behind that. So the question for the old legacy guard active as they come over in these ants, active non-transparent structures, is do they have the guts to get really active or to get really cheap? And so far they don't. And I don't know. I don't know where that fits in the portfolio. That's the problem. I don't know the case for that. So I'm open-minded, though. I don't want to be such a negative Nelly. Sometimes I get accused of being too negative on a couple areas, namely ants and ESG. But I just sometimes, Jerry Maguire, it kind of show me the money. I just don't see much. $1 billion after a year of active non-transparent, given there's 12 of them. And
there's $1 billion totally in all of the active non-transparent funds? Wow. There's probably more than $1 billion spent in the value of the media talking it up before it launched.
That's 2 days of flows for Cathie Wood.
Wow.
So, and they have a lot more resources. So that's how little organic demand there is for that. I almost feel like they're trying to sell compact discs, like a $5.99 CD. I hate to say it. I just want to be right. I want someone to go, yeah, he was right about that. That's just my call on that right now.
Well, it's too early because, the thing about an active fund is you need 3 years of performance before people can really evaluate it. And the question is, are people going to use the mutual fund performance, or are they going to restart it for the ETF? And does that even matter? At this point, are people even buying funds the way they used to based on, performance and Morningstar ratings, or are they just looking at things tactically, worried about the DOL rule and buying cheap beta for their core asset class exposure? And it seems to me it's one of those two. But here's the interesting thing that you told me is that revenues over the last 10 years, that there have been $2.3 trillion of outflows from active mutual funds. But revenues over that time period are up.
Yeah, if you go to 2010, active equity mutual funds had $3 trillion in assets. They saw $2.3 trillion in outflows. So if the market was flat, or if we're in any other business, they would go out of business. I mean, if that was a mall, you are done. You're probably done in 2012 or whatever. Like, it wouldn't take long. So they would have 700 billion in assets, but the market went up like 250%. So they have 6 trillion. And we call that the bull market subsidy, or the $5 trillion mirage. And so there's a lot of collapse that's going to happen in the next bear market. And that's where I think if anybody is in there and hasn't left yet, they probably can't, they're feel stuck in there from the capital gains. They don't want to realize the taxes. So if they have an opportunity maybe in a bear market to leave, or they're just nervous, they're older investors, they just want to cash out while there's time. We saw this in March. There was 350 billion in a month that left those funds. That is crazy, right? That's a bad year, let alone a month. But that gives you insight into how much they are going to lose if there's an extended bear market. So we think that organically, you probably are looking at a world where passive equity will be 80% of the assets till it settles into an equilibrium. And then that would mean that passive funds would own maybe about 40% of the stock market. So, I mean, unless something changes, and then there'll be that sliver for the high active share, the stuff that goes and does some really unique stuff. But I want to go back to a point about performance. I feel as though in the past 5 or 10 years, performance, you can't just beat the benchmark by a little bit, because we've seen many active mutual funds that actually beat the benchmark and still see outflows. So we have this phrase that expense ratio is the new past performance chart. So a lot of the money that would otherwise be in a fund that might outperform by 2 or 3%, that'd be a good year. If your fund beat the S&P by a couple of percentage points, that's great. But that isn't going to cut it anymore. People just don't want to pay the money for that, especially because they might have underperformed for a while. So what's happening is, if you beat the market by like 20 percentage points, or in Cathie Wood's case, like 100 percentage points, I'm talking like, that's why we call it shiny object. If you can lap the benchmark, you tend to get looks. But if you beat it by 2%, it just doesn't seem like it moves the needle anymore. And we have case after case where, so I don't even know if performance will help these active non-transparent or the active mutual funds, perhaps a little, but I just don't see the evidence.
Yeah, look, I mean, I wonder if that's a bull market phenomenon, right? I mean, I've been talking about smart beta funds that are modeled to do 200 to 300 basis points of outperformance over the course of a year, and nobody cares right now because we're in an environment where the whole market's up, 20% a year after year, and there's no risk. And it's like, hey, let's take, if we're going to deviate from passive, let's take bigger swings. I think that's how people feel. They're probably not going to feel that way forever, but this thing about active gathering assets in a down market, and we've been hearing that forever. Oh, just wait for there to be a bear market. Then you'll see active outperform. Then, there'll be a flight to quality. Then you'll see the flows come into active. And you're telling me that 350 billion came out of active mutual funds in March of 2020. That's it. That's game over, is it not?
Yeah. I mean, we our outlook last year at the beginning of 2020 was a bull market's good for ETFs, but a bear market's great. Not only do they thrive in chaos, the trading volume goes up, people really turn to them, but some of those mutual fund people, leave. It's like refugees leaving, I guess, finally freed up to go. And so, yeah, I just don't see any evidence around it. And there is an interesting wrinkle here, which is that this is all equity. Stock pickers just, again, unless you're Cathie Wood and are doing amazing things, it's just going to be a tough road.
So let's talk about Cathie Wood. So I think this is not only the story of our time, the story of our day of 2021 or 2020, I think it's really the story of the whole generation. I mean, we're talking about, if you remember when State Street came out with the fund SHE that was incorporated gender diversity into the security selection and weighting, and they put the Fearless Girl statue out in front of the New York Stock Exchange, and there was such a push by the industry, in my view, long overdue, but there was such a push to be more inclusive to females. There was a pathetically low number of female portfolio managers and investors. And sure enough, right after that, it seems like in the blink of an eye, here comes Cathie Wood. And not only was she the best performing fund manager for several years running, and everyone was skeptical the first year, and then they were skeptical the second year, and she kept going and going. People said, oh, she got lucky with a bet in GBTC. And then they said she got lucky with a bet in Tesla. And now they're saying she's got lucky in whatever she's in now, right? And not only is she the best performing manager, she's absolutely dominated the field. The flows are off the charts. They're, after a slow start now, they're raising more money. People are actually raising the question, can they put all that money to work? Or are they going to be limited in what they can invest in? It's incredible what has happened. How did that happen?
Yeah, I feel like there's always a problem with her with some people. It was just GBTC. It was just Tesla. She's not really beating the Qs. She can't really and now it's like, oh, she's too much assets. She's going to be a whole problem. Or, funds that go up like her, they're going to crash later. And, I don't know what the deal is. Like, what do you want? I mean, if you want to add a little hot sauce to your portfolio and you like what she's selling, I have no problem with it. And she's, maybe she's like the new Janice 20, a concentrated portfolio has a nice run and then has a downturn. But again, the way portfolios are now, I think that a lot of the core of the portfolio is beta and cheap. And so you add a little Cathie on top, it's a little less pressure. It's not like you're replacing everything with her. That I would not recommend. So if you were to sell everything you have and go into the ARK funds, I think that would be a bad idea. But I don't really approach her from that point of view. I assume people are using a small portion to add a little Cathie hot sauce on their portfolio. She has a great way of positioning it. You could agree or disagree, but she calls herself a hedge. She thinks that the S&P, half the stocks are like on the wrong side of this like major transformational shift, and that her ETF is a hedge from that problem. And that's an interesting way to do it, as opposed to saying, hey, I'm just a great gunslinging high, 5-star manager, to say that I'm actually a hedge. I like what she's doing. She's also transparent. She says what she's going to invest in every day. She's on Twitter. None of these active managers, it's probably not their fault. Compliance probably doesn't let them, but she has also dominated the conversation. And you have to be in the conversation, it seems. I'm really don't see flows going. There's many cases in ETFs where the flows tend to go to the person who owned that conversation. Cathie sometimes reminds me of the currency hedge craze of 2013. That's when Abe got elected in Japan, and man, the dollar was strong. So all of the currency hedge ETFs killed it. And
currency hedge ETFs are, what are they?
They basically go long of country stocks, but they hedge out the currency. So in other words, if Japan's doing well, but then you have to convert it to dollars and the dollar's strong, you get less of them. So the currency can actually cut your return in half. So, but if you hedge it, your return doubles, so to speak, right? And so they had a nice run, and Wisdom Tree sent Jeremy Schwartz out. They did all kinds of advertising, take the yen out of Japan. Meanwhile, there was another one from DWS, formerly Deutsche Bank, that actually was a better performing version of DXJ, and nobody cared. And so part of what Cathie's done, I think, is what Wisdom Tree did, which was to seize the moment and become part of the conversation. And you have to hustle. And she, is on there. She takes hits on Twitter a lot. I think they've gotten better. They were really nasty back when she said the Tesla 4000 call. It was 90% negative. We actually studied this.
You studied the mentions on Twitter of Cathie Wood?
We did, yeah, because we were that was when there was many more Tesla shorts on Twitter. And what they would say when I would tweet about her, or other people, it was brutal. They, crazy, this, that, and the other. But they all kind of went away. Tesla shorts are now like, I guess, in witness protection programs, living in a cave. They'll come back out probably if Tesla tanks. But she got a lot of flack. Now I find that it's almost 90% are fans. And so I don't know how many will last if she has bad performance, but I don't think she minds. I think she is okay with chasing away some of the performance chasers. I think she has a core group who like her, and I don't think she wants to be, massive so I think she's pretty happy. I'm not usually worried about getting big or getting small. She seems very peaceful. And I think that actually helps her in marketing, in that she is able to sort of just come across pretty balanced in all of this. But yeah, certainly there is the mania. It only got overshadowed by GameStop. But up until last Monday rather, ARK was really the number one story almost in all of finance, I thought. And obviously it's interesting though, when GameStop and all the Wall Street bets people started buying all these, random like value stocks. Her flows have dwindled a little bit. I think there is some shiny object people that herd and just go after whatever is hot. And clearly they have moved to this other thing. But I imagine she's probably happy. I mean, there's nothing outflows per se, maybe like it's more like flat. But she was seeing $1 billion every 2 days, and that's kind of leveled off over the last week. But who knows what will happen? I mean, Currency Hedge DXJ now has $1.5 billion. I think it peaked at 17 billion.
17. It went from 17 to 1.5.
Yeah, well, it had nothing to begin with. So in a way, if you just remove the middle part of the graph, it's actually grown. But it just took this massive route there. If she has that kind of a long stretch of underperformance, it will be interesting how many people can last. In DXJ, they really got out of there though. So I am obviously somewhat balanced in what I say, but it's hard for me to be anything more than just like really impressed by what she pulled off. Because I tell people this, that she came in as high cost, stock picking, and indie. If you're one of those three things, life in the Terrordome is brutal. And she's all three, and now she's taking in more flows than BlackRock.
More flows than BlackRock.
Yeah, she's taken in $8 billion this year, BlackRock $4 billion. I mean, granted, this is over a small stretch of time, but it's been a month. I mean, it's a month. Like, so for January, she will have doubled BlackRock's flows.
That is unbelievable.
So whatever happens, I just say, applaud that. That's a major one in 20,000 feet or something like that. Like the odds are so ridiculously stacked against this happening.
It's amazing. One of the things that we've talked about that I wanted to ask about was Jack Bogle of Vanguard and his impact on the industry. I'll just kind of leave it there. You tell me your thoughts on Bogle and, Vanguard, I guess, and what his legacy and impact was.
So, I'm actually working on a book project about him and the impact. And the reason I wanted to do this was I had some audio with him where I interviewed him 3 or 4 times before he passed away, like in the 5 years. And some of the stuff he talked about was really interesting. I had probably 4 hours of material. But beyond that, I feel like whenever we write about, we write about funds, some of the things I just told you about active, passive, this, that, and the other, I keep coming back to man, so much of this, if you pull the thread on it and you just keep pulling it like a sweater thread, you end up in 1974, 75, when he set up the company as a mutual ownership structure. That one decision has really just changed everything. And what's fascinating to me is that even though not one company followed that structure, which is interesting. A lot of people followed the index fund, but nobody followed that structure because it's just so against the grain of people who go to Wall Street. They want to get rich, not average. But by setting up mutual ownership structure, you'll make money, but you won't become a billionaire. And so that one move, though, which is against the grain or against type of somebody running these kind of big asset managers, was so impressive to me because over time, even though nobody copied it, most of the industry now is dictated by it. So the whole industry is really running off of this. Like I said, there's a sliver of stuff that goes and shiny objects, as you call them, where flows go in and out. They're fickle, but the big bulk of flows is going to funds that charge below 20 basis points, 10 basis points really, and are passive and largely Vanguard. But even the stuff that isn't Vanguard that takes in that money is really just copied from them. And I just find that to be astonishing. It's glacial. It's almost like covering, the rising sea levels, where it happens slowly, but the impact is enormous. And I feel like I wasn't sure. I wanted to give him my Gen X slightly colorful treatment. And I wanted to interview a bunch of people and sort of get their take on how he impacted mutual funds, how he impacted ETFs. Because remember, the first ETF, SPY, they got the idea from Vanguard. Nate Most thought, hey, why don't we just try to get the Vanguard 500 to trade on the MX? So they went to Bogle. He said no and gave some advice. But the real thing is they priced it at 20 bips so it would be tied with the Vanguard 500. And over time, they obviously lowered their fees to compete. And I would argue that if ETFs weren't priced in the price range they are and they came out at 1%, the industry would be maybe 10% as big. So even ETFs, I think, owe 4 or 5 of their trillion to that initial price point of SPY, which was just because Vanguard was that low. So then you look at the advisory business, the way that a lot of advisors have now become RIAs, they're fee-based, they talk about behavior, that was up his alley. Then you've even got Vanguard going into the advisory business. That's a whole nother issue. Vanguard arguably started the commission-free trading wars. Remember when they launched, that's when Schwab came, and then Fidelity. They kind of started the dominoes of the big guys. And so it was just interesting. I was like, little sub-ecosystem after sub-ecosystem, you kind of see the Bogle effect in every single one of them. And it's not like it's over. It's in process. And I don't know of any bigger thing that there is out there. And again, part of it is also just, why did this guy make this decision? What is different about him? Why didn't anybody copy the mutual ownership structure? Just interesting questions that I just try to work with. But on the flip side, a lot of is known about him, and perhaps some of this is just trite and trodden ground. But I wanted to do it for myself, really. So I can't really understate his impact, and I think his legacy is here to stay. And it's just interesting to me. I don't know, like, what's your take on it?
I agree. I mean, his impact is unbelievable, and I don't know much about him. I don't think a lot of people our age know much. I mean, everyone knows that he was an advocate for index investing and for low fees. Everyone knows that, but I don't know much about him and what really set him off. And I think at the end of the day, he may be credited, or I don't know if credit is the right word, but he may be the impetus for really ending the asset management industry or the traditional fund industry. I mean, we'll see where things go, but we just recorded a podcast, the two of us, with Mike Green, talking about kind of the end game of index investing. And if index investing, takes over even more so than it is now, what happens to capital markets? And I don't think Bogle himself would have ever envisioned that they would get to that point, right? I mean, he was trying to, talk about the benefits of passive investing and build a company when they were small. It's different than when all of a sudden now they're the majority and they're taking in flows that other fund companies couldn't possibly dream of. And the impact has been massive. And you look now at Vanguard, gunning for private equity, for example, right? If they're a mutually owned fund company and they're kind of like a zero sum, they're just going to charge the cost that it takes to facilitate these things. Why would they try to grow? Why would they try to get into private equity? Why would they try to get into other areas of the market? And I guess the answer to that would be that it's better for the investor, right? Because if they can cut down fees to the point where there's no profit to take out other than the minimal operational cost, then it's a virtuous thing. But the idea that they can do that to other industries and other parts of the industry is also a little bit scary.
Yeah, I mean, they're just getting into China. Vanguard in China, and they're teaming up with some big players there. The private equity is interesting. I don't know if they want to disrupt private equity as much as the advisory business. I think that if you have richer and wealthier clients who convert to your advisory service, who have been your fund investors, you kind of need some private equity to offer them. So I think more so they just want that, because I think the advisory, that's what Buckley, he's just said, we think they're charging too much money. We want to disrupt this business. And that's a part of the book. I go into this, but I also talk about Vanguard and Bogle having a gap. I think there is a natural magnet of ambition and more that is just part of the whole Wall Street and asset management ecosystem. And he fought that tooth and nail. But without him, I think there's a natural magnet towards that. And I think you will find maybe a little bit of a gap, and Vanguard's ambition could be more than he would have. You could argue it's good or bad. I'm not, again, I try to be very non-judgmental. I just more so just want to try to show the reader that this is some heavy duty shit. I mean, this is, and it's going to play out for decades. And so it's interesting. But I also have a chapter that is called Explaining Bogle. Well, I really just try to get into the psyche of the guy and some of the experiences. I think it's maybe 70% environmental, 30% genetics, which is what produced this unique individual. It's interesting. And so I go into a lot of different things that I felt maybe came together that made all this happen, sort of inside of him as his experiences. Just to help you understand what makes this guy tick. But I asked everybody I interviewed, I interviewed about 30 people, and I said, are there future Bogles, or is this guy just an anomaly? What made him so different? And people have real trouble answering that question. They're not really sure why he's different. And they are mostly err on the side of he's just a total anomaly. Like it's just the freak accident that happened in this industry that probably just won't happen for a long time.
So ETF IQ, of course, is a TV show on Bloomberg that Eric co-hosts with Scarlett Fu. I've been lucky enough to be on it a couple times, and it's really great because I think you're not just getting the you have guests from the largest asset managers, but you also have guests from independent asset managers and people who are themselves independent. And the independent guests, I think, can speak a lot more freely than the guests who are tied to big corporations. You've been very early in catching a lot of trends, and you guys ask tough questions when appropriate. So it's a show that, I got to tell you, every week when the show was on, every week I get text messages during the show. Oh, did you see this guy, that guy, who's on the show from people I know in the ETF industry? Everyone watches it. Everyone talks about it. It's a fantastic show. So what's going on in the time of COVID with the show? It seems like you're on a bit of a hiatus. Is it coming back? And what's the story?
Yeah. First of all, thanks for that. It means a lot because I put my heart and soul in that because I didn't know when it would end. So I said, I was going to leave it all on the field. And I did. And it did end, or at least temporarily, because we were going strong. But then a little inside baseball, that show requires 2 production crews, not because of my makeup, but because that's my joke. It requires 2 production crews because if there's breaking news, like the president speaking, they got to tape our show and then go live with the other one. Well, right now there's hardly anybody in the office. And so to do a show like that remote, is difficult. They got to sort of circle the wagons with the shows they're doing. So hopefully when the people come back, we can start it back up. Fingers crossed. But that's the status of it. But we really tried hard. And we tried to ask fun questions. And let me compliment you as a guest. You were always very good because you spoke frankly. The people who run the shop, because we actually had Bogle on once, or we had I'm trying to think of somebody else. If you get somebody who's the founder, whether it's the biggest company or the smallest company, those are the best because they don't have to answer to anybody. They have no boss that's PR person who's going to get up in their grill about what they said. So you came on and would speak very freely. So we felt like the smaller issuers were such a fertile ground, and Twitter, frankly, and RIAs who run their own shop, because they would just speak more real. And we tried to really bring a lot of that out, along with having some of the more sort of VPs from the big shops. But yeah, and we would, I would always give Scarlett at least one question that was pretty tough but then she would ask it though, because when it comes out of her mouth, for some reason, this is less confrontational. And I thought we got some pretty good stuff going. And, we wouldn't tell everybody all the questions. We'd have a prep, but we'd always leave 1 or 2 that were not in the prep just to give some improvisational feeling to it. So yeah, I was proud of it. I really hope it comes back.
I hope so too. I love it. Honored to be on it, but even just, watching it, I think it's a fantastic show. It's really, like we talked about earlier in this podcast episode, ETFs are a fascinating industry and an industry that's, seeing growth and all these players, big players, small players. It's a fascinating industry, but it's also global macro. It's also talking about whatever's hot in the market and talking about different markets. It's incredible how it brings all that together. And I think you guys do a perfect job of that in ETF IQ. So let's talk now. Oh, and I want to ask you one more question about that, about ETF IQ. So, you're an analyst at Bloomberg. You're not a TV star, at least you weren't until this. What was that like, that transition from being, just an ETF analyst, now all of a sudden you're hosting a show as an anchor, essentially? Was that a difficult transition? Did you do a lot of prep work on that? Or did you just say, hey, I'm smooth and handsome, I'm going to roll right into it?
Maybe a combination of all those. I think a little false sense of confidence has helped me my whole life. Just thinking I could, at least try it. But no, I'll be honest, what really helped me for that was I went around on the road a lot as a data guy, and I would give presentations all over the place. We did events with different companies. We'd call them tours. And I was speaking in front of PowerPoint presentations all the time. And so my role on ETF IQ is like the weatherman a lot. I'm in front of this big board, which is like a PowerPoint. So I'm natural up there. And the only trick is, okay, you have to end your thought by looking in the camera. Or here, you got to look at over the anchor. Those little blocking and tackling were tricky at first. The other part that was tricky was asking questions, because you have your set questions, and this is where Scarlett makes it look easy. And believe me, she's the anchor. I'm sort of like the weatherman tagging along guy. Or I'm almost like, I would tell her sometimes, you're Jim Nance, I'm Tony Romo. I'll come in with some crazy metaphor, some inside dirt, but you're leading the dance here. But like the asking the questions is harder than it looks. I have a lot more respect for really good anchors because, okay, you have these 4 questions, but like the person, maybe they cover 2 questions at once. Well, what do you skip to the 4th one? Or let's just say like they said something interesting. Do you sit there and dig into that? Because the whole thing has a clock. So it's almost like you're in a ticking clock and you know that, well, if you don't ask it now, you might not have time to ask this one other issue. Or do you let it go for the sake of sort of fluidity? Those on-the-spot judgments took me a long time to get at least decent at. At first, I was very clunky. And that's a tough skill, in my opinion, especially with a ticking clock. On a panel discussion at an event, you can always come back to your point. But when you have 4 minutes or 3.5, and they're in your ear saying 45 seconds, 15 seconds. I mean, it's like, it's like the 2-minute warning in football, like constantly. And that's what makes it kind of fun too. And it's live. You're up on a high wire. I mean, if you stutter, it's on, that's it. Everybody saw it. There's no going back. So it was that was a tough part, but up there at the board going over flows, I think pretty much comfort zone for me.
What do you like the most? I mean, you're writing a book about Bogle. You're, constantly doing analyst work, right? You've got a podcast and you got the TV show. I mean, what if you had to pick one, gun to your head, you got to pick one and this is what you're going to do. What do you like the most?
I like half of my week writing in a hole and just not having to see people. And I like half of my week coming out. And that's sort of what my life was like pre-COVID. Now it's more like it's all 5 days in the hole, but I mean, the podcast counts a little bit, but it was perfect. I don't know if I want to be shining all week on a TV show. Also, I like to go down in my hole to find cool stuff to talk about, as we call it, diamonds. As an analyst, what's fun about being an analyst is you ever seen the beginning of There'll Be Blood when he's in the hole digging for gold? Mm-hmm. And he's just by himself with the bucket. Like,
yeah.
What happens is you're digging for this one idea you have, and then on the side you see something glimmering, and you're like, wait a second, and that's the big idea. And so you can't find that unless you dig, and you can't dig unless you have time. So I really enjoy that process. Because I did public relations for a couple of years, and it was a fun job, and you circulate a lot, but you don't go deep. You're really on the surface a lot. And then if you did an analysis and charts full time, you would be only deep in the hole constantly. And I kind of like the mixture. So I guess that would be my answer. So my life pre-COVID was I don't know, it was pretty ideal. So I hope we get back to that. And I also like traveling like once a month, like maybe 2 days a month. That's also nice. Miss that. Do you miss traveling or are you like happy?
Oh my God, do I? So, I think there's a certain personality type that, becomes energized, right? You're going out, for me, when, pre-COVID, I'm going out and I'm doing meetings and I was spending about a third of my time in New York and the rest of the time here in Michigan, except for other trips, conferences, speaking. I just posted today on Twitter a speech I gave at Inside ETFs just because I was like, oh man, it's the end of January, early Feb. Like this is Inside ETFs time. And I was just kind of like thinking to myself how much I missed it. Like, I think there's a certain personality type that's truly energized by, sitting there and flying out and meeting with people and doing things. And I feel like for myself, I'm one of those people and sitting here, I'm working now on some really awesome stuff with an amazing company doing some fintech stuff. But a lot of it is just sitting in a basement while the kids are on school and I'm checking on them and I'm coming down and, making sure that I'm doing stuff that is, really cool and important stuff. Like you said, it's like digging in the hole, right? I'm digging in the hole right now a lot, but I don't have that opportunity to then come out. I'm going to have a Twitter feed. I have this, right? I have this podcast is what I have, but I get a lot of energy from that and I miss it. I miss it so much. I miss, running around doing media. I miss doing meetings. I miss all that. And to me, that stuff is like my energy source. That's what gets me pumped up and okay, now I'm going to go back to the well. I'm going to go back in. I'm going to do the hard work and find some cool stuff to talk about and find some, positioning or whatever it is, and then go back out in a few weeks. Like, it's not just that. You're like, I'm totally with you on that. If you're only out front, then you're losing a lot of the substance and a lot of the credibility, I guess, or you're skipping the steps that would build the credibility that would make you better at being out front. And you kind of need both, but without the opportunity to go out, it's been that's been probably for me one of the hardest things about this year, just trying to stay energized and, stirring up the pot and trying to find ways to get all that without being able to go out physically and do it.
Yeah. No, I think everybody's in that same boat. There's definitely some pros to being home, and you're when you're done work, you're right there. There's no commute, which could be annoying.
So, Eric, I like to ask this of all my guests. Tell me about an obstacle that you've had either in your professional life or your career that you've either found a way to work around or persist through.
I guess one that comes to mind is just not having a CFA. I mean, I wasn't really sure what I wanted to do in college, but I wrote for the college newspaper, and I liked that. So journalism appealed to me, and I kind of liked economics, but I didn't like it enough to go on the normal track and get a CFA. And I feel like that inhibited me. I've met and worked with CFAs, and some of what they're able to bring to the table is really good. Sometimes I'll discover something on my own, and they'll go, "Oh yeah, that's just the formula this guy made, and that's why we studied it." Because I'll independently be like, "Why don't they have something that just does this?" And they're like, "Yeah, they do. It's called this, the Sharpe ratio or whatever." But what I did to get around it was I just, especially when the TV show started, and I had to go to New York and cover all these ETF angles, and I knew I was going to be on live TV. Man, did I start buying books off of Amazon right and left. I bought the bond book. I bought a book about oil. I bought a book about options. So I just Amazon booked my way through a lot of this. And that's how I got around it. Now I feel like my alternative background complements well with the CFAs that are on my team. And I think we gel well together. So, but that's what I did. But I've always felt a little lacking in that department in terms of my academic credentials.
Yeah, well, I could say the same. I started CFA. I did the Kaya because I was working for a company. We were going to build out our alternative funds, and I did CFA 1, then Kaya 1, Kaya 2, went back to CFA 2, had kids, and forget it. Once you have kids, that stuff is impossible. But there are so many successful people that do not have CFA. In fact, one of my guests on the podcast for the ETF experience is a guy named Dan Kupkovic, who's a head of investments at Argy Financial, and his answer as well was, he had taken the CFA level 2 numerous times, did not pass it. And when he came to accept the fact that he didn't need the CFA designation to be successful in his career, was his answer to the same question. And sure enough, he's been remarkably successful in his career despite not having the CFA. So I don't think he needs it. I don't think you need it. I don't think I need it. I wouldn't stress it, but that is a great answer. So, I want to thank you for coming on the show. Thank you to our audience for your time and attention. Eric is Eric Balchunas. That's EricBalchunas at twitter.com. You can find the Trillions podcast anywhere you get your podcast. You can find ETF IQ on Bloomberg TV after COVID is over, once they are able to come back online. The ETF Toolbox is available on Amazon, anywhere you get your books. And hopefully we'll get a Bogle book soon from Eric. Eric, thank you so much for coming on the show.
Pleasure, Phil. It's always nice to talk to you. Thank you for having me. And thank you to our audience for your time and attention. We'll be back next week.
Thank you for listening to the Phil Bogle Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.